Fed minutes showed a very hawkish Fed. The majority of members actually favoring 2 more hikes, cuts all but off the table. How does that shape your view of the markets going forward in the second half and also the possibility of a recession?
So it's actually very similar to what we've been thinking. And I think you have seen the market expectations certainly move to this more hawkish outlook for the Fed with continued hikes. And as Julian had said, this is a higher for longer outlook that we're now starting to get from the Fed. For the market, that's a really important narrative. So we've had a wonderful first half of the year where the risk assets have done extremely well. You had high hopes for maybe a soft landing and also hopes for a soon coming end to Fed tightening. But as we are now becoming more aware, more familiar with the idea that the Fed is likely to continue hiking, that's unfortunately going to hit market sentiment through the second half of the year. And the further that the Fed hikes, of course, the greater the chance of an economic slowdown. So unfortunately, that is likely to weigh on risk assets this year.
All right, so Fed minutes do give us some insight, but in all fairness, it's backwards looking. But now we're looking ahead. The Fed said it's data dependent. Tomorrow, we have the monthly jobs report, really the big one. One of the things they've been watching is wage growth. And while the jobs numbers themselves have been kind of up and down and had some surprises, wage growth's actually gone down fairly steady. So I want to ask you, wage growth, total jobs, is there any metric in this report that could possibly change the Fed's mind about a hike, at least in the next meeting?
It's quite unlikely. I mean, within the minutes, they did specifically mention the jobs report, the fact that payrolls have been very, very strong. If you were to see a significant downward surprise, so a really major fall in payrolls, then maybe that's enough to change the Fed's mind. You'd probably need to see inflation data also softening in order to push in that direction. But certainly, we're not expecting the jobs data tomorrow to show considerable weakness. We're expecting that to come through as you get closer to the fourth quarter. But for tomorrow, that's not going to be enough. And as you said, the wage growth numbers have been slowing, but not slowing enough. So they need to see further evidence of that and really overall putting together the jobless claims data today, the JOLTS numbers out today, as well as the jobs report tomorrow. Together, that's going to give them an idea of how tight the labour market is at the moment. And they need to see the labour market starting to unwind and loosening over the coming months.
All right, give us a sense how you're looking at the second half of the year. What sectors are you looking to for opportunity? Are there some sectors that maybe you're just trying to stay away from?
Well, so we have had a fairly significant overweight to technology so far this year, really in that mega cap tech space, which fortunately has done very well. Some segments of that is looking quite frothy. It's very, very expensive. It's fairly overvalued. And as you're seeing expectations for Fed tightening to increase, unfortunately, that's likely to weigh on some of those stocks. So we don't think this is a good time to increase exposure to technology. But certainly if there is a bit of a pullback, we would want to increase our exposure given the very significant secular AI forces behind that. In terms of other sectors, we think that given we're moving towards a slowdown, this probably isn't the best time to be increasing your exposure to cyclicals. So really focusing on more of the defensive areas, utilities, healthcare. Those are the areas which are likely to do well. And as services start to slow down over the coming months, maybe consumer discretionary parts of that is where we want to avoid.